A gradual, 10-year transition to an Islamic financial system would have profound and complex social impacts on the rich-poor divide. The effects would be a mix of direct, intentional redistributive mechanisms and indirect, systemic consequences. Here's a breakdown of the potential social impacts on economic inequality, potential impacts for reducing the rich-poor divide, the pluses. Wealth redistribution through zakat, the mechanism. Zakat is not charity. It is a mandatory 2.5% annual wealth tax on savings, gold, and certain assets held for a full year above a minimum threshold, nisab. This is a powerful, built-in tool for wealth redistribution from the rich to the poor and specific categories of people in need, Quran 9:60. The impact: a properly administered and centralized zakat system would create a continuous, predictable flow of capital from the asset-owning class to the poor. This could fund poverty alleviation, social safety nets, education, and healthcare on a massive scale, directly tackling the wealth gap. Erosion of dynastic wealth through the prohibition of riba, interest, the mechanism. In the current system, those with significant capital can earn substantial, risk-free income through interest, bonds, savings, treasury bills. This allows wealth to beget more wealth with minimal effort, cementing dynastic fortunes. The impact: without interest, the idle rich cannot simply live off coupon payments. To grow their wealth, they are forced to invest it in the real economy through risk-sharing, mudarabah, musharakah. This makes wealth growth contingent on actual economic activity and job creation, not mere ownership of capital. It forces capital to be productive, which benefits society more broadly. Increased access to capital for the unbanked, the mechanism. Islamic finance's asset-based and partnership models can be more accessible to those without collateral. Instead of needing a credit history or assets to secure a loan, an entrepreneur with a good idea can seek partnership with a bank, which provides capital for a share of the future profits. The impact: this could unlock the entrepreneurial potential of the poor and middle class, enabling social mobility and creating a more meritocratic economy where success is tied to enterprise and effort, not just initial wealth. Promotion of ethical and socially responsible investment. The mechanism: the prohibition of investing in harmful industries, e.g., alcohol, gambling, excessive speculation, directs capital towards socially beneficial sectors like infrastructure, renewable energy, education, and healthcare. The impact: this would lead to more inclusive development. Investment would be channeled into projects that create jobs and improve public welfare, rather than those that can extract wealth while causing social harm. Potential challenges and risks, the minuses and complications, initial capital flight and wealth preservation tactics. The mechanism: the ultra-wealthy, facing a mandatory zakat and the loss of risk-free interest income, might initially seek to move their capital to conventional financial systems abroad. The impact: this could lead to a short-term capital crunch, potentially hurting the economy and, ironically, harming the poor through job losses before the new system stabilizes. Effective capital controls and global coordination would be needed. Complexity and potential for Sharia arbitrage by the elite. The mechanism: complex Islamic finance contracts, like Tawarik, which is controversial, could be exploited by the rich and financially literate to replicate interest-based, low-risk returns, effectively circumventing the spirit of the law. The impact: the system's benefits could be undermined if a two-tiered system emerges, one truly risk-sharing and equitable for the masses, and another, sophisticated one for the elite that preserves their privileged financial position. The risk-averse, poor and the cautious, rich. The mechanism: while risk-sharing is fair in theory, a poor person might be terrified of taking a profit-loss sharing loan for a small business. If the business fails, they lose everything. Similarly, banks might become more cautious in their partnerships, preferring to finance established, wealthy businesses over risky startups from unknown entrepreneurs. The impact: this could paradoxically reduce access to capital for the most vulnerable and entrench the position of established, wealthy players, potentially increasing the divide if not managed carefully with government guarantees or support funds for small entrepreneurs. Dependence on a strong, incorruptible institution. The mechanism, the entire system's success hinges on the effective, transparent, and corruption-free collection and distribution of zakat and the fair regulation of Islamic banks. The impact: if the governing institution is weak or corrupt, zakat funds could be misappropriated, and the financial system could become a tool for favoritism, benefiting a connected elite and worsening public trust and inequality.